Investors tracking the rise in Treasury yields. A host of economic data in the next week and the election could cause more volatility. Join us now, Subadra Rajappa, head of U.S. rate strategy at Societe Generale. And it's like basis points, but I'm obsessed with what the 10-year. It's 430. It's gone up. It's gone up almost every day since they cut, and it's still not out of control. It's probably all normal, and you're going to tell me not to worry. But is it signaling anything about the return of not necessarily the vigilantes, but just people that might be a little worried about that the Fed has declared victory too soon on inflation? Is there anything to that?
Not really. I mean, the data has actually justified the market pricing.
What does that mean? The 430, because of the strength of the economy, it should be at 430.
Yeah.
Okay.
So we had this 50 basis point rate cut in September, and since then the data has been very, very strong. We got a very strong payroll print. Retail sales has been very strong. Revisions to GDI and GDP have been very strong. You're tracking 3% GDP for the third quarter, and there's a decent amount of momentum going into the fourth quarter.
Yeah, and new highs in the stock market, and talking about more cuts. You just made the case for they shouldn't have cut in the first place, and they certainly shouldn't cut from here.
Well, that was our view, actually, believe it or not. We were thinking the Fed would probably be on hold for the remainder of the year, and then the market quickly started pricing in a 50 basis point rate cut in September. And even then, I would say that we think that we were thinking that the Fed should have a much more measured pace of easing. And now the market's very much aligned with our view that the Fed will take a much more measured approach on policy. I'd say the last 10 basis points of the sell-off might be related to the elections. There's a little bit of a caution heading into the elections next week. You're seeing that especially play out in the vol markets, perhaps in the strength of the dollar and other assets like crypto. But for the most part, I would say that the move in yields has been much more fundamental than related to the elections.
Doesn't it seem like both candidates would be inflationary to some extent? At least what they're talking about.
It's possible, but for the most part, I would say that the tariffs is where you're going to see that step up in inflation for 2025. Really, the market is still, in my view, discounting the magnitude of the impact that we could get from the tariffs, expecting that that's going to be much more of an opening salvo for a negotiated deal, and that we might not see that 60% tariffs on China and 10% tariffs on all imports. If we do something anywhere close to that magnitude, I think that's going to be somewhat inflationary for 2025. Beyond that, of course, it's the rate of change, and the impact is going to be a lot more muted.
How have the auctions been going? When will we test the water for whether we can, keep rates coming down, even though we're trying to sell so much, the U.S. government?
For now, I think that it's not that much of an issue. If you look at, we get a Treasury refunding announcement on Wednesday. And what you're going to see is that the Treasury is probably going to keep coupon issuance sizes, relatively unchanged for the next fiscal year. So you really need to start seeing those coupon issuance sizes increase meaningfully. And that's going to come after we get a little bit more clarity on what the policies are, who wins the elections, what they're planning to do on the fiscal side. For now, I would say it's much more status quo. So sort of an immediate reaction for me is going to be on the inflation side, depending on what the outcome of the elections are. But for the most part, I think that for a meaningful increase in coupon issuance sizes, that's something that we're thinking about for next year, not this year.
I don't know what's happening with my. Sometimes I think it's the GERD. I do. It's not a cold or anything like that. It's like. I share a lot. I do share a lot.
Sometimes too much. TMI.
Share a lot with you. I'm trying to bring them in to understand what's happening. I don't think that inflation necessarily is as under control as people think. Is it? Is it possible that we could be in the beginnings of at least being disappointed on a continuing downtrend? Not necessarily going back up, but is everything great right now?
So far, so good. It feels a little bit like a Goldilocks scenario, but typically, if you look back at inflationary episodes going back, historically, even to the 70s and 80s, the decline in inflation or the disinflationary trend tends to take a lot longer than people anticipate. And that's what you're seeing in the Fed's projections as well as our economists' projections, where the normalization to that 2% inflation target could take a couple of years or longer. So that disinflationary path is going to be a lot slower than people anticipate, especially because the market's going to react if the Fed continues to cut rates. Because in an environment where growth is relatively strong and the job market is holding up, when the Fed's easing policy, that's something that's going to be somewhat stimulative, and you could see perhaps a tick up in services side inflation as a result of that.
You've got oil, which is cooperating, but then Boeing, those people are not cooperating in terms of, I mean, they're going to be.
You mean in terms of the inflation picture?
Yeah, in terms, you got strong labor. They can ask for a lot, and the strikes they get. We never used to talk about 35% and 40% wage increases, and that's what everybody wants. But oil certainly is a tailwind, I guess, at least today.
Yeah. I mean, the geopolitics are, of course, an ongoing concern, so you could see a spike up in oil. But really what you're looking at for inflation expectations is perhaps what happens next week after the elections. Yeah. And that, I think, is an underpriced risk in the market. If we do see a substantial increase in, say, the 10-year break-evens or inflation expectations, that might be something that could cause the Fed to kind of pause at the November meeting, especially given how strong the data has been. I mean, they don't want to be seen as hiking rates in an environment where inflation expectations are rising sharply. So that's something that I'll be looking to see next week, post-elections.
Okay. So you think the market has come around you didn't think they should have gone 50? Did you think they...
No. We thought that they should, the market was priced in for 25. That seemed like it was the outcome. I mean, the market, I should say, was priced in for 50, but our expectation was for a 25 basis point cut at the September meeting. We're expecting 25 in November and December.
Now it's slowing down to where you think it's better. We're showing it right now.
Yeah.